Hey, everybody. Thank you for joining us today. We're going to give uh, everyone a few minutes to join. We have a number of registered attendees today, so we want to make sure that we give everybody a chance to log in before we get started. Um, the session is going to be recorded, so everybody will get a copy after the session. So, Chris, where are you joining us from today?
I'm in downtown Manhattan.
Oh,
Um,
nice.
so at a offices of Ellington Financial, I go into about every week. They're a parent company for us,
Oh, okay.
and I live in the city, so it's easy to do. Had breakfast this morning, and
Headed right
been a
in.
good day so far.
I love it. Yeah, we were just in New York for the secondary conference, and I think they almost hit record heat that week that we were there. It was quite hot.
Yep. Well, we've had a cold and miserable spring and maybe winter and snow and the whole bit. So I'm perfectly happy to get a little bit of heat coming in.
I
But sec
bet.
was, sort of like going from 0 to 80 or 0 to 90, almost literally over a short period of time.
Yes, that was something. But it was a great event. We had a great conference that week. All right. I know you have a lot to cover, so I don't want to take up, too much time for us, just talking. So I'm going to go ahead and get started. I'm going to do a quick intro for you in just a minute. But we welcome everyone to please post your questions to chat if you have any questions. Chris has a lot of great content today, but he is open for questions at the end. So if you have any questions, please post it to chat and we'll make sure we address as many questions as we can during this time. This is a 45-minute session today. And so Chris Mayer, Dr. Chris Mayer, is CEO of Longbridge Financial and a leading voice in housing finance. With a career spanning academia, public policy, and capital markets. Since 2023, he has guided Longbridge from a startup to one of the top two reverse mortgage lenders in the US, driving product innovation and scalable growth, excuse me. Professor Emeritus at Columbia Business School and former Federal Reserve economist, Chris has testified 6 times before Congress and been featured in the New York Times, the Wall Street Journal, Bloomberg, CNBC, and NPR, among many media outlets. His work focused on helping older Americans access home equity through responsible, transparent solutions that support financial security in retirement. Chris also holds a PhD in economics from MIT. Without further ado, I'll turn this over to Dr. Chris Mayer.
Great. Thank you, Mimi. This was, I think, going to be a fun, I'm looking forward to a fun discussion. And I think this should work really well. Tell me, do you see the chat on the screen or not? No. Okay. All right. I'm going to get going. So we will definitely have time for questions at the end. Please put things in the chat. And look forward to talking with all of you. So I'm going to cover a number of things today. I want to start with where we are in the overall economy. I'm going to focus on two things. One of them is AI. The other is the divergence between the top and the bottom. People have talked about the K-shaped economy, K-shaped recovery, various kinds of metrics. We'll talk a little bit about that. Then I'm kind of come back to traditional economic metrics that affect all of us in the mortgage industry, inflation, jobs, interest rates, et cetera. And then talk about the implications of all of that for the housing market, where prices rising and falling, how is it impacting different people around the country, and then a little bit of speculation about what the future holds, and in particular how to manage things in the current economy, and then we will definitely have time for a Q&A. So that's the game plan. The first is, it's a lot of housing economists actually will start and go a fair bit through their talk before they ever talk about AI. It's really hard not to at least say something about what's going on in the economy, particularly with relationship to AI, and just how important it is in where we're sitting today. If you look at the growth this year, AI spending directly through data centers, energy, and I'll say productivity gains from AI, although there haven't been so many that people can point to. If you look at the latest data from MBA, for example, the cost for originating a loan in their most recent data went up, not down. So, for those of us who are trying to look at AI as a way of really creating great efficiencies, I think the mortgage business is like many other businesses. We haven't seen it so far, but we're hoping for the best because we're certainly spending money and resources on the investments to get there. Industrial renaissance, semiconductors, again, driven by AI, pharmaceuticals, more of that than you think is AI in defense. A lot of that is also AI. And then the one big, beautiful bill, lower household taxes, 100% expensing of many things. Again, a lot of that's AI and infrastructure, again, AI. So when you kind of think about what is driving where we are in the economy, depending on how you measure it, and it's not exactly right, but if you added up all of the AI investment at the end of last year, it basically represented almost the entirety of GDP growth. So AI is driving a lot of stuff, but it's driving a lot of stuff with the hope and expectation that it's going to generate benefits in return. And obviously, there are some reasons to worry. The 10 biggest companies make up 40% of the S&P, and when SpaceX goes public in, whenever the IPO hits, it may be 10 or 11 companies, and that may be 45% of the S&P 500 or more. So there's a lot of betting and a lot of leverage that is driven by excitement on the AI side of the universe. And again, should we be worried? The answer again should at least be a little bit of a yes. I'm not saying that the world's going to collapse, and I'm not a doomsday person, but at the same time, there's a lot of concentration on AI. If you look at consensus US outlook, solid growth and high inflation. Those two things are not great when you think about what the implications of that are going to be for housing and mortgages. But certainly the inflation, the issues about how this is going to affect the overall economy and inflation, if we think the Fed is going to be raising rates, which I think people are expecting, there's a lot of upside risk here. And I'll come back to that at the end. Upside on the inflation and rate side. If you look at pivoting over a little bit to where we're seeing economic growth, there's been lots of stuff written on the K-shaped economy for consumers. And I'm going to show you a bunch of data to say, I think this is a real thing. And the K-shaped economy is really driving not just the economy, but politics as well. And when you think about what's going on, there are winners and losers in the current economic environment, and the losers represent, I say losers not in the sense that they're people who have problems, but they're people who are facing relative challenges in the current economy. And so you have basically this problem that almost anybody that's looked at the data is seeing two things happening at the same time, which is strong economic growth and a historically strong stock market, contrasted against a growing number of consumers who are facing real problems. And so if you look, for example, there's really been a gapping out in terms of how low-income households are seeing the world relative to high-income households. And so people who are under 50,000 really haven't seen any increase in confidence or belief in what's going on. Whereas at the top end of the market, consumers making over 100,000, consumer confidence is much higher. Notice in all of these groups, consumer confidence has been falling. And that's sort of troubling in a world where the stock market is predicting ever-growing earnings, while consumers are not seeing the world so positively. But consumer confidence is not a great predictor of the stock market, but does tell us something about what's going on in the world. If you look at inflation, low-income households are experiencing higher than average inflation. Low-income households here in the blue line, at the bottom 40% of the market. Again, these are data from the New York Fed. If you look on the other side, from the wealth perspective, People at the bottom in the light blue are the ones whose real net worth is not growing as much. Minus 20 and 20 to 60 are the blue and the red. And they're basically always at the bottom. And who's up at the top? The 99 to 100. And the 80 to 99 are next. So the top of the market has seen huge pickup in wealth, net worth, financial assets, wages and benefits, all of it are going up to the top. And it's, this, by the way, is historically what happens when you have a technological boom. So I'm not saying AI is any different than what happened when we've seen past technology benefits. In fact, there's a really famous economic paper called The Economics of Superstars that basically points out that for centuries, as you've seen technology improve the ability of a society to make things, that technology has also enabled the most skilled people to increase their wages and wealth more than the average person has. And that has ebbed and flowed, but that's been a pattern for centuries. And certainly AI and technology has continued to accelerate, or depending on your perspective, exacerbate that problem. And again, we're seeing this in politics in a big way. Um, if you look at the credit market, if you look at the bottom, revolving home equity and mortgage has seen very little uptick in delinquencies. And where we've seen it, it's been predominantly in the FHA side of the market, although some of that has to do with changes in how FHA has actually treated people who have delinquencies, et cetera. But some of it is real. On the other end, if you look at auto loans and particularly credit cards, delinquencies are at really high levels relative to historic data. And almost surely the people who are defaulting on credit cards and auto loans are people who are seeing ever increasing prices of cars with tariffs and with the cost of construction rising, and people who are facing challenges with inflation and credit cards. And those people are presumably the ones who are facing defaults. And, auto loans are now 72 months, and even longer to borrow against a car. And so people who buy a car are basically underwater almost from the get-go and underwater for years, given how far they're pushing out their auto payments. And so there's a lot of pressure on people at the bottom that people in the upper middle and the top are not feeling. So let's talk a little bit about how some of that's, let's sort of look at some of the other economic fundamentals, and we'll come back to the housing market. The first is, maybe not surprisingly, inflation is up sharply since the Iran attacks, and is well above the Fed's 2% target. And if you recall the chart I showed you earlier from Bloomberg, you'll see that, if you look at the going ahead forecast, right, people are seeing inflation that's going to be well north of 3%, throughout all of 2026, and even potentially into 2027. And most of those forecasts are driven by a view that we're going to expect the Gulf to open fairly soon. And every time there's a rumor that's floating around that says that, this or that's going to happen, when you come to Monday, there's no agreement and seemingly no sign. And I'm not a political I'm not, an expert in the Middle East, and I know nothing more than any of the rest of you on the call do. But, I've started to gain some measure of skepticism that these announcements are not really driven by things that are going to generate a political solution. It's starting to feel like a lot of the geopolitical problems fit into the same bucket, which is they're kind of going on, and we don't really find answers to problems, whether it's in Ukraine, whether it's in, different parts of the Middle East and elsewhere. We're not seeing lots of solutions. We're not seeing lots of cooperation. All we're seeing is tension and, trade problems and other things, political problems accelerating. So again, I'm an economist. I'm an expert in political economy, but I think all of us kind of can see the same things out in the world. If you look at this is from the TIPS market. This is what I sort of refer to as the 10-year expected inflation rate. So this is what investors who are looking out 10 years think inflation is going to be. And we've been tapping up against the highest level for 10-year inflation almost 2.5%, the highest level that it's been in 3 years, and bumping up against the highest level that it's been in quite some time, like decades or more, in terms of where expected inflation is. So more and more, I think people have gone from saying, politicians have saying, we're going to do everything we can to stamp out inflation, to say, well, maybe we're just going to have inflation. If you talk to consumers, the thing they hate the most is inflation. And if you want to look at things about consumer sentiment, if you want to look at voting and other things, it's really not surprising that consumers hate inflation, because the people who are most exposed are people who are in the middle and the bottom. And those folks are really facing challenges from rising costs that are make it tough on their day-to-day lives and experiences. Um, when people are saying, I'm not going to fill up my car and I'm going to give up my regular vacation and just go to somewhere that's really close by, that's not a great world for people to be living in. They don't like living in that world. And, the response to that is not very good, not surprisingly, again. If you look at the 10-year Treasury, that's also spiked since the war in the Middle East. And, we're bouncing up against levels up and down that are high. And you got to believe that there's still upside risk here on the 10-year Treasury relative to where it's been before. Not saying it'll get there, only that the risk is, high if our tensions and prices continue to rise. If you look at longer, higher for longer just seems like the scenario that is a realistic scenario for where we're sitting today. And it's at all parts of the yield curve. The yield curve starts at the short end of the yield curve, where higher inflation is going to push up the expectation. Fed rate decreases seem less and less likely. And in fact, now the bond market's betting that the next Fed move may be up as opposed to down. In the middle, you have a ton of debt being issued by hyperscalers, people who are funding data centers and other things. And so you have a lot of debt coming out, 3, 5, 7 year, debt that's financing some of this stuff. And at the long end of the curve, sooner or later, we've already passed 100% of GDP in terms of our debt. Sooner or later, we are going to have to pay our bills. And there seems to be no political consensus anywhere on either side of the aisle to face up to that issue. And we're also, starting in 2030, going to start to have problems with Social Security again. And so all this stuff is eventually going to have to lead to finding a political consensus to rein in spending and to actually increase taxes to pay for the debts and to pay for the rising costs of Social Security that's coming down the pike. And when that happens, again, I'm not one of those economists that puts a forecast and a date in the same sentence, because I don't really know the when, but I do know that eventually these problems are going to, are appearing and will reappear. It's just a matter of what and when are the triggers. And again, that's hard to figure out, for an economist or for most economists, but it doesn't mean that we can live in an unreality where we don't have to pay our bills and where we don't have to cover the costs of government spending, including particularly on the rising share of the elderly. And as we cut back on immigration, we make our population older, not younger. And so immigration changes just exacerbate some of the economic challenges that the country's facing. And we don't have to look very far. We can look at places like Japan and China to see the implications of some of that in terms of overall, economic growth and the ability of, governments to be able to fund what they're doing and the challenges there. If we look at the mortgage market, one of the upsides has been, despite rates rising, the 30-year mortgage rate has not gone up so much. The reason for that is, at the same time rates have been rising, we've seen spreads between the 30-year mortgage and the 10-year Treasury come in. And mortgage spreads right now are just under 200 basis points. That's kind of a relatively low level compared to recent history. If you go back in time, of course, mortgage spreads, 200 basis points would be a really high spread relative to mortgages. Some of that is higher for longer is actually good for investors in mortgages, because it makes refinancing less likely. And if refinancing is less likely, then mortgages are worth more. 30-year mortgage bonds become worth more. And people also think there's relatively little credit risk associated with defaults. So the combination of those things and the idea that they think the volatility of future, interest rates has come down a bit, that is higher for longer. We've seen spreads drop. And as spreads have dropped, that's actually helped a little bit in terms of the overall impact on mortgages. And finally, wage growth has started to pick up, which in a world where people are saying AI is going to take out, low wage workers, et cetera, we are seeing people switch jobs. And if people want to ask, I'm happy to talk more in the Q&A section about, the impact of AI and wages and why I'm much more skeptical than I think other people are that we're not going to be able to find jobs and productive things for people to do in a world even where AI is doing substantial amounts of things. So I'm not one of these doomsday people who believes that we're just not going to have anything for people to do in this world. That may happen. I'm not sure I'm going to be around to see it. But, maybe we will eventually get there in terms of where our society is. But certainly AI, has a lot of potential for making the economy and individual firms more productive. But more productive firms can make wages go up, not down. If workers becoming more productive means that they get paid more and there are things for people to do, then that can push up wages, not necessarily just push them down. So I'm not again in the camp that AI is just gonna, is just guaranteed to crush the wages of everybody around. But boy, I could understand people at the lower end of the market, the low middle income people looking at this and saying, all my costs are rising. I'm worried about my job and wages. I'm going to struggle with where I am. And boy, the world's looking tough for me. All right, so let's talk about the housing market. The first is this is U.S. home prices. This is the Case-Shiller Index, came out a couple of days ago. What have we seen post-COVID? Prices went up a bunch. Then they fell a little bit as rates rose. Then they've kind of gone up and they've kind of been flat. So we're not seeing very much home price appreciation. And when you look, it really matters where we are as to whether home prices are going up or down. So if you look at the data, everybody for a long time post-COVID was basically the South and parts of the, really the South and, the coastal part of California and then, the Pacific Northwest, no, those places are all going to be shedding people. All those cities have economic problems. People are leaving California. People are, leaving the Northeast. There's, going to be nobody left, and everybody's moving to the South. And no one should ever really believe that that story was a permanent story in terms of, what was going to happen in the overall economy. I'm not saying that there aren't migration trends, but of course, those things have moderated and changed over time as economies and housing markets have adjusted. And what have we seen? The places where, people are leaving, people have kind of stopped leaving so much. And what are we seeing? Home prices are rising in the Northeast and the Midwest, and home prices in the South are falling. What's driving the decline in home prices in the South? Well, part of it is construction, good old-fashioned construction. When home prices go up and there aren't barriers to entry, there aren't zoning rules and other things that get in the way, what happens? Home builders build, and the cost of construction is lower there than it is in other parts of the country. So what's happened? We built a bunch of stuff. If you zero in on Austin, home prices in Austin are down more than 20%. What happened? I can show you pictures of all the cranes that have gone up all over Austin. People have built houses. What's happening in Houston, Dallas, parts of Florida, same thing. People are building houses. The other problem in Florida, and at least parts of Florida, is, the cost of insurance. And if you look at California and the cost of state-sponsored plans, homeowners insurance has gone up a lot. That's really a drag for California right now is the cost of insurance and the challenges associated with climate change. But it's also certainly a problem in Florida and places which are, homeowners that are seeing just astronomical increases in the homeowners insurance. Ironically, actually, insurers have been very profitable because the last couple of years there haven't been any major storms, and there haven't been any really big fires since the LA fires a little while ago. And so insurers are actually making quite a bit of money, but they're not returning it to consumers in the form of lower insurance premiums. I think their view is that it's just a matter of time before more problems happen again. So how do we understand the run up in home prices? What a lot of people will say is, well, there was a housing bubble. Very easy. Home prices went up, and you saw the last time we saw this in the mid 2000s, home prices went up and then they collapsed, and then they sort of see, gee, COVID hits, home prices go up, and they're waiting for the collapse. And there were a lot of prognosticators who talked about this and said, it's just a matter of time before housing prices collapse. I would argue that we're not in the same environment that we were in 2005 and 2004. For those of you who were in the mortgage industry at the time, liar's loans, all the kinds of crazy credit and underwriting that existed in 2003 to 2005 that led to home prices going up. We're not seeing that today. There's none of that. There's no crazy underwriting and other stuff that's driving trillions of dollars credit to come into the housing market. We're not seeing loads and loads of speculators who are buying to flip houses. I'm not saying there's not some of that going on in specific places. Again, I could point to Austin and a few other markets, but it's limited. It certainly isn't nationwide. What did cause home prices to rise? There are some people that argue, and a lot of people argue, we just haven't built enough housing. I'm going to argue part of the reason we haven't built enough housing is because construction is very expensive. Wages have gone up. Construction costs of materials have gone up. Tariffs have just further increased the cost of construction, and the idea of doing all of this stuff in the United States has just further run into problems, trade issues with Japan and Asia, where steel and lumber, sorry, with Canada and where steel and the Asian lumber from Canada, all those kinds of things have made stuff very expensive, and just overall cost of inflation has pushed up the price of construction. And so if you look at inflation adjusted residential construction costs, for the longest time, construction costs rose with inflation. But post COVID, we saw construction costs up 13%. Well, I just told you home prices went up about 12% above their trend line of 1.1% a year, and construction costs went up 13. 12 and 13 seem pretty similar. So if you look at construction cost adjusted home prices, which is home prices net of the cost of building houses, basically home prices are right on the path they've been on, going back to the data we have starting in 1987 with Case and Shiller. So in other words, part of the thing that people don't talk about very much, the reason that home builders aren't building more stuff is the stuff they're building, they're having a hard time selling, and they're having a hard time selling because of what it costs to build relative to what they can sell. And they have to, they're spending a lot of money subsidizing mortgages and other things to try and get people into houses. But it's not that home builders aren't willing to build stuff. It's that the cost of building is high, and the prices, even given where they are today, aren't fully justifying the cost of putting that stuff up. So home builders are struggling a little bit, and that's the challenge. If you look, you can just see it in the data. Single family starts, which averaged about 1.2 million up to 2007, have averaged only 773,000. And yes, they've gone up a little bit, but they've plateaued, and they've certainly plateaued well below the level that home construction averaged for decades. If you look at multifamily apartments, where people are able to produce much more efficiently, we saw construction peak in 2023 at a 40-year high. And construction of multifamily and apartments has been higher, not lower. And so I would argue this is driven by the cost of building single family housing relative to multifamily housing and where rents are relative to prices. And so rents on single family houses have gone up a lot. Rents on multifamily haven't gone up as much. What's that showing? Again, it's a problem associated with the cost of building stuff. The other interesting thing I want to point to has to do with where we're seeing home prices. Interestingly, given my thesis, the construction costs are a problem. Home prices have been rising more at the bottom than at the top. So people at the bottom who are getting squeezed in other places are really getting squeezed in buying houses. So across the country, the bottom tier, the lowest tier homes are the ones that have been going up the highest at the highest rates. And if you think that a home is land and structure and labor costs have gone up a lot, a smaller home is disproportionately affected relative to a larger home where land represents a higher portion of the value of that home. And so you're ending up seeing low tier prices. The cost of building a starter home has been very high, and home builders, given the costs, aren't building so many of those. And the bottom end of the market, affordability has become a huge problem. This isn't a New York story. It's not just a Chicago story where we're seeing the same thing. It's not just a San Francisco story, ironically, seeing less of it in San Francisco than anywhere else. And it's not just a Phoenix story. This is a story across the country. So go back to my K-shaped recovery. Now these people are facing higher inflation and they're getting hit harder by the cost of housing relative to other people. And you're not surprised that people aren't really adding to home, home ownership isn't rising and home ownership has been falling, particularly for young households. So for younger households, the home ownership rates have just been declining. Who are the homeowners? More and more, they're older people. They're older people who got into housing earlier. And as people buy later in the life cycle, they continue to remain to be homeowners. But the homeownership rate for people 65 plus is still 77, 78%. And for 55 to 64, it's above 75%. Most people have historically become homeowners as they've gotten older. So where is the demand? Where are people moving? Those rates are all the home ownership rates, the average age of buyers are all going up, not down. Housing wealth, again, tied to home ownership. So how do I think about the future? Finish up for questions. 4 or 5 takeaways. The first is anything that can help affordability will have a market, but the headwinds are really high for low middle income buyers. Inflation, gas prices, rising home prices at the bottom of the market that are outstripping average home prices are really, really tough. Historically, more than 80% of Americans own their own home, including more than 2/3 of people who never graduated from high school. Home ownership has been something that has been widely spread throughout the country, and all of us in the industry can be proud of what we've done there. That is becoming increasingly difficult given the K-shaped and the economy and the pressures at the bottom. The second is I would argue that it's not just the lack of supply. The lack of supply is really driven by the high cost of construction, and that we've got to bring construction costs down if we want to affect affordability across markets. Immigration limits may help a little bit in the sense it's going to reduce demand, but immigration limits also really raise the cost of building because immigrants build a lot of the houses in this country, and labor shortages are an appreciable problem for people that are trying to increase construction. The third, the elderly are a really strong opportunity for lenders. A third of all homes are owned by households 65 and older, and the elderly face a lot of the pressures that I talked about earlier. Inflation, wages not rising since they're not working. People who have a lot of assets are doing really well, but the K-shaped recovery, where you have almost 80% of the elderly owning their homes, means there's lots of cash out opportunity, and there's lots of opportunity to bring products to those people if you want to focus on that market. And finally, I think mortgage rates are likely to be range bound in the current economic environment. For the moment, you can sort of say, well, if we just get control of inflation, maybe the Persian Gulf opens up, inflation comes down later this year, maybe that's going to bring down treasuries and bring down rates. The problem is when that happens, I think we are also likely to see mortgage spreads start to rise. If refinancing becomes a viable option, people who are doing mortgages look and say, you know what, if mortgage rates are going to fall, my loan's going to get refinanced out from under me as an investor. That's not good news for me, and mortgage spreads start to rise again. So in a way, kind of the things that we have good news for rates may be bad news for spreads and vice versa. And so you may or may not see something that, we may not, this hope that mortgage rates are going to get back into the fives, et cetera. For us, we should be really happy given where the 10-year is going that we don't see mortgages get back into the sevens, which I'm not saying they're going to, only that, there's upside risk as well as downside risk. And there's definitely recession risk if we start to see defaults or other things happen in the mortgage market. And finally, in the overall economy, I think there's upside risk to inflation. There are tons of articles from oil price analysts who basically say, you know what, so far China and the US have been, putting out more oil from the reserves. That stuff's going to work for a while, but sooner or later it's going to eventually be a challenge in the market. And I think there's, I'm not an expert, but I believe that, you got to believe intuitively there's upside risk here. Spreads on mortgages are at historically low levels in terms of, in the proprietary market and reflecting low default risks. I think those could potentially rise. Will we see a strong AI productivity boom? To me, we've seen AI investments. We got to see the return on that investment. And there's a big question of who the winners are going to be. And you could imagine a world where AI improves productivity, but competition between AI providers basically doesn't allow the AI providers to make lots of money. And so the AI companies don't earn big profits the way they're predicting, but instead the benefits are, consumers and firms that are using AI to increase productivity and to do other great things. And you may see the price of AI usage rise substantially. I think that seems reasonable. And it may be that the stock market has overvalued some of the AI firms and has undervalued some of the companies, including some of ours, where there's opportunities for productivity improvements to really improve where we are. So that's it. I'm happy to take questions. And let me take a look in the chat. I'm terrible at multitasking. So I don't know, maybe if you have questions you can see, or if not, people can put them in the chat, and you can feed me some questions or thoughts.
I'd love to. We don't have any questions posted in the chat yet. We welcome any questions that you have. Thank you, Lisa, for your comment. She says, fabulous presentation. Thank you.
Thank you, Lisa.
Yeah. I mean, this really puts a lot of things into perspective, Chris. Thank you for sharing your expertise with us while people are kind of thinking about the questions. Really kind of tie in everything that's a challenge right now with labor costs, labor shortage, young household not being able to afford housing and so forth. Larry has a question for you. Do you anticipate any changes in the reverse PLF tables based on rates being where they are?
I think I got through the entire presentation without using the words reverse mortgage even once. I will say, and it's kind of a goal. I wanted to talk a little more broadly. I think I don't see LTVs or PLFs rising either with the government or right now with proprietary loans, given where rates are. I think if rates fall, there's potential for those to go up. But I think at least the PLFs right now are probably in a range they're likely to stay. And I don't see the government doing, the FHA doing, I don't see PLF reforms as kind of the primary place where the FHA is likely to make some changes. David's asking what percentage of senior homeowners own their home free and clear. If you look at people who are 65 years old, 65 to 69, about half of them own their home free and clear, and about half of them have a mortgage. That drops to about 30% when you get over age 70, but significant numbers of people continue to hold mortgages into their 80s. So we will, so you do see mortgage debt is an appreciable challenge for many households. Is now the right time to buy? I still teach. I love teaching, and I get this question with my students all the time. Lots of other people, is now a good time to buy or not? I think housing affordability has gotten better over the last couple of years in the sense that home prices have been more range bound, and particularly in the places where home prices went up the most, they've kind of come down a little bit. I think people who are waiting for home prices to really fall out and for there to be a real opportunity when, that bump up kind of comes back down again. I don't see catalysts for that. So if somebody's waiting around for home prices to come down a lot, maybe if you're in the South, there's some prospect for that happening a little bit. I think most people should be buying a home that they can afford when they can afford it, kind of given the environment. But it's expensive and it's tough. And first time home buyers, there's kind of the old joke, nobody goes to that restaurant anymore because the line's too long. Well, the idea that nobody's buying homes because they're too expensive can't really be right. The reason they're expensive is because people want to buy houses. And so that point, the impact of supply and demand is showing up in terms of higher prices. And I don't, absent a recession or absent seeing another run up in mortgage rates, if we see mortgage rates go above 7, is there downside risk to the housing market? Absolutely, even into the upper sixes. But waiting isn't going to help you because you're going to pay more for a mortgage even if home prices soften. So it's not necessarily going to be a win. So I think people should look at the housing market and make a decision based on where they are in their own circumstance. If you've got one kid, you're living in a condo and another kid on the way, like, you should be looking to buy a house because, if you can do it, you can do it. And historically, the economics of buying houses in this country over long enough periods of time have been very strong. And I have no reason to, I'm not one of these people that says, you should never rent. And all the people who say you should buy a home don't know what they're talking about. I think there's no evidence to support people who make those kinds of comments. I think buying a home is a valuable thing for all of us who have been homeowners and, raised a family. When you're in your home, you're not looking and saying how much of my home was worth. You're looking and saying, how are things going with my kids and what are my neighbors like? And how do I think about my community? And what am I going to do on Saturday morning if I don't, keep working on the new room downstairs or fixing up this thing that I'm doing? So I think home ownership is ingrained. It's a great thing to do. And I continue to be a fan of buying a home. Um,
Now, Chris, we have a couple more questions left if you have
yeah.
time.
Yep.
Sandra De La Cruz asked, do your statistics reflect Spanish-speaking clients, including I-10 borrowers?
Um, I've never seen data that looks at Spanish speaking borrowers or other I-10 borrowers separately. Um, I don't see any thesis that any of what I've said would be different for people in different demographic groups. So I would, I don't have a different view for, Spanish speaking households. Obviously, it matters who they are and where they are in the socioeconomic spectrum. And so people who are in jobs that are doing well and living in communities, and with positions that are higher, that are higher end and benefiting from the top part of the K are still going to be doing well. People who are at the bottom end, who are facing the bottom part of the K, are facing challenges. So that's a problem. Now I see these politics will be a big challenge of the economy because there's no economic policy going forward. I don't necessarily, I'm not sure. Yeah, I'm going to stay away from politics other than to sort of say I think no matter where you sit in the political spectrum, politics reflect the underlying anxieties that are going on in the economy. Every politician across all sides of the aisle, when they are running for president, if they want to run successfully, are going to run on an economic platform. And in the current economic environment, if you're an incumbent, you should not feel very good about where the current economic platform is relative to what you're running on. And honestly, the political folks have not, maybe done enough to help. Um, and AI technology and mortgage process, I could spend an entire other discussion on our company and how we see it. I see AI technology helping a lot and creating efficiencies, which are really valuable. I don't see us replacing people. I don't see us replacing LOs, underwriter, even the people who have the best technology. Underwrite, manual underwrites and, having human beings look at loans are still important. And one of the things I'm always struck about in the mortgage industry is when you realize how many people have some kind of special circumstance who are applying for a mortgage. You say, why aren't there more people who have just regular garden variety things? And people are just people. They just have strange things that happen to them that require some kind of exception, look, other kind of thing going on. And it's just kind of way it is. And so I think we're not going to get rid of the impact of people in a lot of these, particularly in sales, underwriting, but processing, closing, those are going to all become more efficient. But we're not getting rid of people in all of this. But they're making, we've used in our servicing team, we use bots to reach out to people to sort of say, have you filled out, your form, your occupancy certificate? We're ready if there's a crisis for the bots to reach out to every person in a servicing portfolio and say, we're here for you. If you want to talk to a person, hit a button and you can talk to a person. But they're not replacing the people. The people are focusing on higher end kinds of problems. So we've not gotten rid of people in our servicing and servicing oversight team, but we're using AI for them to focus on the things that are most helpful for our clients. Could the FHA lower structure rates differently? Yes, we could see reform at the FHA and IMIPs for those of you who are in the weeds. Yes, there's opportunities to do that. I'm not going to make a prediction as to whether the FHA will do that or not. Those of you who are following NRMLA, I think NRMLA, I sit on the NRMLA executive committee and board. NRMLA is doing a lot of work to try and be helpful on that. Somebody said, I love doing reverse mortgages. I believe this is an ideal time. I couldn't agree more. I'm not trying to pitch reverse mortgages in this talk, but I think if you look at the data, the opportunity in the space is really strong. And if you look at growth in proprietary, not just HECM, I think you're seeing very, very high growth rates in origination of senior lending kinds of products that have been really, really big and much faster than we're seeing growth in the overall kind of traditional forward market. So I think there are tons of opportunities there. I think we're basically running out of time. I think
are.
we have a bunch of questions about reverse mortgages that I'm not going to be able to answer. Part of the focus of this was a broader economic housing discussion, but I think maybe I'd love to set up some more time here September and, in the annual meeting, to kind of find opportunities to talk about some of these things, because I think there is a large and growing opportunity for lending to seniors given where the economic environment is. But thank you for having me and for running this.
Thank you, Chris, for your time and expertise. We really appreciate you sharing this information with us. Now, if you guys have more questions about Longbridge and what they can do to help you guys, please reach out to us. Happy to connect you with Chris and his team to provide you with more information about Longbridge and the wonderful service they provide in the reverse space. Thank you, everybody, for joining today. You will receive a copy of this recording after the session, and we hope you enjoyed it as well. Thanks so much,
Right. And
Chris. Appreciate you.
thanks for the Mortgage Collaborative for this and all the great work you do. You guys are really awesome. So,
Thank you for your partnership. Have a great
all
day.
right. Bye-bye, everyone.
Bye.